please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You're still tuned into Power Breakfast this Monday morning. Well, let's quickly recap what took place on Friday's session. The stock market was rocked by a sudden plunge in financial shares. Markets saw panic selling and a V-shaped recovery on Friday's session. The Nifty saw a sharp fall around lunchtime and breached even that 11,000 mark, but recovered by close to end only 1% lower, while the Sensex breached that 35,000 mark and was down over 250 points, however, by close. Banks shed 650 points to end slightly above the 25,500 mark, while the mid-caps tanked about 450 points. But Nigel is going to tell us all of the cues and news we need to watch out for. There seems to definitely be a fear factor in the markets.
Oh, definitely. The screen is telling you that. In Friday's trading session, we moved around on the Sensex, close around 1,000 points odd. And on a day-to-day basis, first we want to track our deficit numbers. We're always looking at crude prices as well as the dollar index. The SGX Nifty is indicating maybe a start off on the back foot of close to around 20 points. But remember, most of the Asian markets are shut. So we're pretty much starting off on our own steam. Brent crude prices moving to $80 per barrel, not great news. Dollar index, though, holding below that, at around that 94 odd mark. In fact, it's moved higher in comparison to Friday's close. So both those two factors are not working in our favor. But the big fear now is the illiquidity in the debt market. That's something that's led to weakness in the equity markets. And that's precisely the reason that in Friday's trading session, you had stocks like DHFL, India Bulls Housing Finance, even Bajaj Finance and LIC Housing Finance. All the stocks at one point of time, they were down more than 10%. DHFL ended down more than 40%, but they recovered from the low point of the day. But in spite of that, we saw some of these stocks get an absolute whack. Banking stocks as well, led by Yes Bank, were under some selling pressure in Friday's trading session. So you had PNB, Yes Bank, Kotak, Axis Bank, all of them did see selling. Now the big fear now, the new fear really, is that the debt market tightness. One is il&fs had suddenly downgraded, the paper of il&fs. So that was one factor. It's half-yearly closing, so as his liquidity is tight. And the last factor is that, in fact, we're bracing ourselves for a rate hike in the first week of October. On the back of that, the debt market has been very, very tight. And there's been more bad news that came over the weekend with regard to the il&fs group. They've announced that they've defaulted on letter of credit to IDBI. So that's not good news. And there are more resignations that are coming out of their subsidiary, the financial services subsidiary. So the MD, the director, independent directors, they have tendered in their resignation. All this means is, will corporates come in there to seek redemptions? Remember, most of the funds, or some of those funds at least, they have already written down their paper by close to around 50% or thereabouts. But now there is an attempt by the RBI to soothe nerves. They are saying that they're tracking all the developments very, very closely. They're ready to take appropriate action, both RBI as well as SEBI. That's a development that came later on in the weekend. And that's an attempt to soothe the nerves. Even SBI chairman, in fact, did make a statement that they won't be averse to lending to NBFCs. So that's some cooling off nerves. The big point at this point of time, and the key focus will be resolution plan for il&fs group. Show me the money and how much money is required. That's going to be the most important point. Can the shareholders, creditors, everyone come to the table and sort this out? Now, in an otherwise weak market, we had a few winners in Friday's trading session. So we'll keep an eye out on all those stocks. TCS, IDC as well did end with sharp gains. And remember, from the lows, we recovered 250 points on the Nifty. The Nifty Bank recovered more than 550 points approximately. And at the end of the day, the flows were positive. Both the FIs and the DIs, they were institution buyers. While in the futures market, we did see that, in fact, there was unwinding on the index futures. Net, the FIs, they're more net short than net long on the index. And in fact, if you're looking at levels, then you should be looking at around the 11,250 mark. That's going to be the important mark on the upside. While the bulls, they'll be hoping that they can defend Friday's low of around 10,866 odd.
Stocks?
Well, stocks, we'll be looking at quite a few of those stocks, DHFL as well as India Bulls Housing Finance. Both of them are going to be in focus for sure. They reached out, to some of the rating agencies, both CARE and ICRA for DHFL. They have reaffirmed the NCDs as well as their CPs. So that's, an attempt to tell the market out there that nothing's really wrong out there. Indiabulls Housing Finance, ICRA as well has confirmed the ratings both on commercial paper as well as on NCDs. So keep an eye out on both those two stocks. And Tata Steel, they signed a definitive agreement with Usha Martin. This was in the works for a long time. It's a positive for Tata Steel because, they're getting more exposure to the long products business. No gestation period. Valuations as well pretty much, favorable for them. So the stock should open up in the green. Usha Martin, well, reduction of debt. That's going to be the biggest positive for them. In other smaller stocks, ITD Cementation, they won an 850 crore order, so keep an eye out on that one. And a couple of companies, now they're coming in with buybacks. With the erosion that we're seeing in share price, TD Power, first attempt by the management to protect the share price, so they're coming in for a buyback on 26th. And even Kochi Shipyard, they're saying that they're going to be looking at a buyback on October 8th.
After the manic fall in share prices on Friday on fears of redemptions and nil liquidity in the bond markets, Reserve Bank and SEBI have issued a joint statement on Sunday that, and I quote, they are closely monitoring the recent developments in the financial markets and are ready to step in. How important are these statements? Lata is here to decode them for us. Lata, over to you.
Well, what we need to remember is that Friday's equity market fall was because of a debt market illiquidity. And the center of that problem was il&fs getting downgraded suddenly in the month of September, on September 8th and September 17th, all the way from AA plus to D. Now, the market's fear thereafter was that there will only be sellers and no buyers because they started looking at other paper which also could be illiquid. They also were worried that there will be redemptions. And that is why there were more sellers and hardly any buyers. And who were the guys who were most affected? The people who depend on the debt market, which is the NBFCs. They raise money only in the debt market. And therefore, this statement can be a very big boost to both debt market and to NBFCs who depend on the debt market. Now, you must remember SEBI is the regulator of mutual funds and RBI is the lender of the last resort. Okay, now SEBI would have data on redemptions. We don't know. The talk in the market is that Friday there was not so much redemptions, but it is possible that after the Friday effect, today there could be redemptions. But what RBI can do as lender of the last resort, what it did in 2008 and 2013 is, it says we will give a line of credit to NBFCs or to mutual funds, more importantly to mutual funds. And last time they had done it, RBI cannot give money without collateral. And if they say we give collateral only of government securities, they may not have. So they, last time around, they took all PSU bonds. So if you have a commercial paper of certificate of deposit of SBI, all that is valid. You can give it as collateral and you get a line of credit from the Reserve Bank. That was what they did in 2008 and repeated in 2013. Now, the important point is mutual funds didn't use their credit. The credit lines available. The very fact that Reserve Bank was there to give them emergency lines ensured that none of the corporates went and asked for redemptions. So that is my expectation today. Just the fact that Reserve Bank and SEBI have said we are watching the market is enough to give signals to the debt market that if there is a problem of liquidity and everyone coming for redemptions at the same time, you have this lender of the last resort who may give you. RBI and SEBI have not said anything. They've only said we are watching, but it's quite possible that, therefore the pressure of redemptions could reduce.
Okay, so the statement should soothe nerves.
Absolutely.
But Lata, stay on. In a bid to, in fact, find a solution to the beleaguered infra lending company, il&fs, the Reserve Bank, as the regulator of NBFCs, has summoned the shareholders of il&fs, LIC, SBI, HDFC and Central Bank for a meeting on the 28th of September. The board of il&fs is scheduled to meet on 29th September, and the regulator probably wants to ensure a plan is in place. Lata, more on that?
This is a story we broke yesterday that the Reserve Bank has summoned the shareholders of il&fs. Now, the shareholders, the biggest shareholder is LIC, which has over 25%, 25.3% or thereabouts. And the other shareholders, Central Bank of India, State Bank of India, and HDFC. These are the Indian shareholders. The foreign shareholder is Oryx of Japan. Now, and Abu Dhabi Investment Authority. That's a sovereign fund of Abu Dhabi. I don't know what will be RBI's status vis-a-vis these two because they are foreign shareholders. They can only call and reprimand the Indian shareholders for not stepping in when or not doing enough diligence on il&fs's loans. Now, the fact that they have called itself means the shareholders will be a little worried and will try to patch up a plan. We understand from Business Standard this morning that Oryx of Japan is interested in taking a majority stake. Now, that's important because a 3,500 crore rights issue is already in the works and is expected to be discussed at the September 29th board meeting. This meeting at RBI is on 28th. If the Oryx story is right, I mean, this is not our story, it's a Business Standard story. If it is true, then il&fs can really tide over. But then one wonders if Oryx was ready. The first default happened in August. September to 60 days, and did not the shareholders speak to one another and get Oryx to make this commitment? So we don't know. We have yet to see the money on the table. But at the moment, this is a very big morale boost to the debt market. The il&fs problem may not be as large if the shareholders cough up. At the moment, the other shareholders I spoke to believed that there could be a bit of a write-off that everyone has to take. But now that, you know, the Business Standard story for me is only 5 minutes old, I just saw the story. We don't know if they come with more money, you know, then even that haircut will not be needed. But I can't vouch for that story.
Okay, all right, Lata. Thanks very much for that. So definitely a developing set of pieces of news we need to track. But we spoke to a whole host of experts on what they make of the crisis in the financial services sector. Let's listen in to what they had to say.
So what's happening is that multiple things compounded with the fact that the banking is right now tight on liquidity. This is a typical period where mutual funds have redemptions. They're prepared for it reasonably well, but these are events which are beyond one's realm of preparation. The only saving grace is that you need to make these investments for a minimum of 3 years if you want to avail of long-term capital gains tax. So therefore, and then the second reason that bulk of this money in the industry is retail and sticky money, the tendency of outflow may not be as fast as could it be for some of the liquid and ultra short-term category funds. But clearly this is not a credit scare which is leading to a panic, but more of a liquidity driven selling pressure which is accentuating the panic in the market.
If you look at the broader finance company sector in India, we're talking about players predominant in retail. I mean, the ones that have been prominent in the last 2 days are in mortgage finance. And the contrast between what's happening in infrastructure financing, which is where il&fs is, and what's happening in terms of the broader retail market can't be starker. We do have concerns that there is some froth building up in retail, but that's more of a cyclical correction. So when we look at the broader solvency metrics, clearly I don't think there should be any cause of concern on the retail financiers. It's quite clear that il&fs would need some sort of extraordinary support, and it's not obvious that that sort of support will be forthcoming. So there are, I can't see any clear and obvious way outs of this issue. So then when we think about the banking system, we would assume that a large part of this exposure will become NPL. Of course, the loss given default would ultimately vary, depend upon exposure is at what level to which project and what's its status. But as a first step, I think our base case is that most of it will end up in NPLs.
Most financial sector entities, whether it's NBFCs or HFCs, rely on borrowing to lend onwards. The moment that liquidity, is stopped, then clearly, you see the issues being sort of blown out into a solvency issue. So how do they fund, their subsequent growth or even disbursements that they have, approved, and then it affects every financial sector entity, because if the cost of borrowing for company X goes up because of its liquidity concern, the cost for company Y is not going to be lowered down either.